This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh, and in today's video I wanted to talk about Scentre Group's half-year results. So they reported yesterday, and we've seen the share price move a little bit since then. So today I wanted to talk about the results, what I think about it, and how I see Scentre Group performing for the rest of this year, because as you know, there's been a lot of lockdowns happening across Australia and New Zealand, so that will definitely impact a business that operates these living centers or shopping centers. So we'll take a look at that, and with no time wasted, let's get right into the video. So over here is the share price of Scentre. It's up 2.21% today, even though they did report yesterday, but yesterday the stock price was up around 6.6%. So the market must be thinking that they've actually delivered quite a solid result to justify a re-rating of the stock. Now, obviously, the stock is still down 3.4% over the past 6 months, but since its lowest point in late July, when there were a lot of talks about lockdowns being extended in New South Wales, if I'm not mistaken, this was the most pessimistic time for the stock, and since then it's actually gone up 12.5%. So now let's talk about the highlights of the half-year results. As you can see, operating profit up significantly, 28% on the 6 months to 30th of June 2020. In terms of funds from operation, which is a key metric that you use when you're analyzing REITs, this number is 8.94 cents per share. So that is up 28% as well. They have very strong cash flows. We see receipts in the course of operations at 1.3 billion, up 30%. Net operating cash flow surplus was 487.7 million. That is an increase of 113% on last half year. And the distribution per share that they've declared is 7 cents per share. So this stock has already gone ex-dividend. So basically, if you buy the stock now, you won't get the 7 cents per share. It's also worthwhile noting that the company has a dividend policy to distribute up to 100% of FFO. The 7 cents per share declared is around 78% of the FFO that they've made of 8.94 cents per share. So the management team is probably trying to be more conservative, not paying as much as they can in order to conserve some sort of cash during this uncertain time, or alternatively, they're trying to give themselves some leeway to increase the dividend if things go well, or to maintain the current 7 cents per share dividend if things go south. So the results today basically showed us that the business has recovered very nicely from last half year, where there was a lot of lockdowns across Australia and New Zealand. And if you look deeper into the half year presentation, you can see that the revenue that they generated and the tenants also generated revenues close to the pre-Rona level. So if you look at total sales generated by the tenants, you can see that total excluding cinema and travel was at 11 billion pre-Rona, and during Rona it took a big dip at 9.4 billion, and now it's back up to 11.1 billion. So obviously not all segments had recovered the same. So travel and cinema did take quite a beating. So it went from 0.8 billion to 0.1 billion in this first half of the year. But this also shows us that the restrictions, once removed, consumers want to return to Westfield centers to purchase and consume goods, services, and experiences. So this does show that there is that pent-up demand, and if you look closer on a more detailed perspective, you can see that in different states, there were some states that had lockdowns, but you can see sales had no impact really. So in Victoria, there were 19 days of lockdown in the first half of this year, but you can see sales pretty much was similar to pre-Rona levels. The only state that didn't have similar levels of sales were in New South Wales, and they were locked down for 15 days. And even then, sales was down only 0.2 billion or 200 million. So that's not bad considering all the other states and New Zealand as well had higher or similar level of sales compared to pre-Rona levels. So pent-up demand is real, and that is also seen in the gross cash collections by Scentre. Pretty much went back to normal at 200 million per month. So this is a very good result, and it does show that pent-up demand definitely exists, and a lot of people go back to shopping after lockdowns are eased. Now, if we look at the balance sheet, what I found that might be concerning for some people was that the total assets for this first half of the year was less than the total current liability. So total current assets at 1.6 billion versus total current liabilities at 2.2 billion. So if you do basic accounting, you know that the current ratio is less than 1. And what this tells us is that the business won't be able to meet its current liabilities as and when they fall due within the next 12 months. However, if you look at their funding resources, you can definitely see that they have enough liquidity of 5.7 billion to pay off that current liabilities when they fall due. So this did look a little bit odd at first glance, but then when you take a deeper look, you see that they actually have plenty of cash. And it is also worthwhile to note that this business is graded A in terms of its credit worthiness. So that means that this business is very strong and will be able to pay off its debt. So it's a very high quality business underpinned by high quality assets. If you look at their financial position for this half of the year, you can see that net balance sheet assets per security went up by 1 cent. So not much of a revaluation in terms of their investment properties, and we might see that in later years ahead. So I don't think we'll see a huge re-rating by the end of this year because Rona looks like it'll still be around, or at least still impacting how the business operates in this half of the year. But perhaps next year we might see a re-rating closer to $4, which was where they were at pre-Rona. All right, now management did give us an outlook, forward guidance into the remaining half year, and the group continues to target a distribution of 14 cents per security for the year to 31st December 2021. So they've already declared a 7-cent dividend. So essentially they're saying we're going to pay another 7 cents in the second half of the year. And this is based on the assumption that the current government restrictions substantially ease by the end of October 2021. So let's take a look at where Australia is currently sitting at, because most of their assets, 80% of their asset value are in New South Wales, Queensland, as well as Victoria. So these three states and their current situation is key to understanding how the business will perform within the next 6 months ending 31st December 2021. So over here we can see that Sydney is still in lockdown, and they've entered into lockdown late June. So it's been quite some time now and they are still in lockdown. The lockdown in Melbourne was extended to 18th of August. Currently it's the 25th, but it had been extended to the 2nd of September. So the Delta variant has been quite effective in keeping people under lockdown, as well as in Queensland. Some states go into lockdown, some states come out of lockdown. So it does get quite messy in terms of keeping a track of which areas are in lockdown or not. But basically, on a high level, you need to understand that Delta is pretty bad in Australia. I don't know if I have any Australian viewers, but if I do, let us know what is happening over where you are at. So always keen to hear your thoughts. But in New Zealand as well, we are in level 4 lockdown, and we don't know yet when we will get out of that level 4 lockdown. So things are pretty bad at the moment. So there is a path of freedom, and it has been announced by Mr. Morrison. 3 different phases: phase A, phase B, and phase C. Phase A is basically there's harsh measures, people are in lockdowns. Phase B is the country transitions when 70% of adults are vaccinated, and this will relieve some of the restrictions that are currently in place. And then phase C is pretty much back to normal when the country reaches 80% vaccinations. So based on the current rate of vaccine delivery, 70% target is forecasted to reach for Aussies aged 18 and older on these following dates for these states. So the key states that we need to look at: New South Wales, this is on the 21st of October. For Victoria, this will be on the 17th of November. And for Queensland, this will be on the 10th of December. So management's assumption that lockdowns start to ease in late October might actually come true, especially for New South Wales based on this forecast. But obviously with a forecast, it can be better or it can be worse. So if we're looking generally, it'll be roughly that date. So maybe management will deliver 14 cents per share in distributions But even if they don't, it won't be very far off from October. So there'll definitely be an impact on the performance this half, but in my opinion, it won't be too significant. Even if they don't pay 7 cents per share dividend next half year, it might be 6, it might be 5. Doesn't make too much of a difference in my opinion. So I certainly hope that things get better in Australia, not for the sake of making money on the stock, but for the well-being of people. And I know a lot of viewers are also from Australia, so definitely hope things get better for you guys and you have good company during the lockdown. But if you don't have good company, definitely stay tuned on this channel because I will provide some entertainment value with these videos. All right, so that will do me for today's video. I think overall Scentre Group is well positioned regardless. The valuation is very low. I did mention that I want to build this position out to a 20% position. However, since I started my position, the price has only gone up. So I've never actually increased it from 10 to 20, but I'm happy with my current allocation. I still see considerable upside to the current share price of Scentre. Even if, you know, things don't get much better by October, even if it's next year, I am a long-term shareholder. I'm not too worried. You know, the difference between 3 and 6 months for me is not a big deal over the long term, as long as my thesis plays out correctly within the next 2 years, 3 years, I'll still be very happy. And I think that it'll be very rewarding for shareholders who stick around for that time frame. All right, so that's my opinion only, not financial advice, of course. If you enjoyed today's video, be sure to hit like and subscribe. But thank you guys for watching. Until next time, take care.